Good morning, my name is Gavin Leo Smith. Today we're going to be having a look at Citigroup. These are the items that we're going to be looking at today, starting off with the nature of the business, the recommendation, the financial review, the divisional review, the group's capital position, and lastly the company guidance. So moving on to the nature of the business. Citi's two divisions are Global Consumer Banking and the Institutional Clients Group. This essentially splits the retail and corporate operations. By looking at the contribution to earnings, you can see that the corporate side of the business is much larger, making up around 70% of earnings. The revenue generated in this business is split between banking activities and markets activities. Banking comprises of investment banking fees and lending. Markets is the trading activities of the business, and therefore earnings can be quite volatile in this business as it depends on market volatility. Relative to other US banks, Citi has a relatively larger portion of its earnings generated outside of the US. They have a strong presence in emerging markets, with Asia and Latin America making up 23% and 12% of earnings respectively. Europe, the Middle East and Africa, or EMEA, makes up 20% of earnings, and North America makes up the remaining 46%. Now moving on to our recommendation. We expect the return on equity, or ROE, to improve over the medium term off a low base. This will be driven by both capital returns and efficiency improvements. The capital returns driver is not something unique to Citi. This will be beneficial for all US competitors. However, Citi's approved capital returns are larger than other banks and therefore should have a greater positive impact on the return on equity. I'm going to discuss this in a bit more detail later in this presentation. The rising interest rate cycle in the US should be positive for lending margins in North America. Management has set themselves relatively more aggressive efficiency targets than we have seen with other competitors, and the timing of our expected improvement in the return on equity depends on management's ability to execute on their guidance. Given the ability to achieve a higher return on equity and 14% discount that the share is trading relative to its book value, we see value in the share. We therefore recommend an overweight position with a recommended exposure up to 5% of your portfolio. Just as a note, Citi should trade at discounts relative to its competitors. This is because the ROE, even though we expect it to improve, will still trail competitors. The return on equity is the primary driver of valuations for banks, at least in our view. Therefore, the higher the return on equity, the higher price to book multiple the company should trade at. Moving on to the financial review. Just as a note, I'm going to be discussing the results on a quarterly year-on-year basis, meaning I will be comparing the second quarter of 2017 to the second quarter of 2016. Net interest income, or NII, declined by 1%. This was due to a lower net interest margin of 2.72%, which we have not seen with other US banks given the higher interest rate environment. This offsets a 3% increase in average interest-bearing assets. Average loans, being the largest component of interest-bearing assets, increased by 2%. The growth was contained by the ongoing wind down of the non-core portfolios. Net interest income generated on the core loan portfolio increased by 7%. Credit provisions, which is a reflection of the bad debt experience, increased by 25%. Credit costs were higher in both the retail and corporate businesses, but more so in the corporate business. Non-interest revenue, or NIR, increased by 7%. NIR made up 39% of net revenue, meaning that the business is more geared towards lending activities. Expenses were well managed, only increasing by 1%. This resulted in an improved efficiency ratio, an unchanged efficiency ratio of 59%. For those who are not familiar with banks, the efficiency ratio measures operating expenses as a percentage of net revenue, which is the sum of both net interest income and non-interest revenues. As the name implies, it measures the operating efficiency of the business. Net income or earnings contracted by 4%. This was due to the decline in net interest income, higher credit costs, and a higher effective tax rate. Diluted EPS, however, was up by 3%. This reflects a decline in the weighted average number of shares due to share repurchases as a part of the capital return plans. Book value per share, or net asset value per share, increased by 6% to $77.36. The ROE and return on tangible common equity improved to 7.4% and 8.5% respectively. Now moving on to the divisions. Starting with the institutional clients group, or the corporate business, net revenue increased by 6%. In the banking business, net revenue was up by 13%. This was driven by strong investment banking fees across debt and equity markets, as well as advisory fees. The performance was also aided by good growth in the lending business. Net revenue from the markets business was down by 5%. However, this is actually quite a decent result, being ahead of market expectations and the group's guidance. In the prior period, the business benefited from high levels of market volatility ahead of the Brexit vote, which ultimately led to a weaker performance in this business off a high base. This was seen across the industry. Average loans increased by 3%. Credit costs were 6% higher as the group built up its reserves this quarter. The efficiency ratio improved to 54%, down from 55%, with expense growth below net revenue growth. Ultimately, the division achieved a 6% increase in earnings. By region, net income was up 11% in North America, 12% in EMEA, and 6% in Asia, while Latin America's earnings were 15% lower. Next is global consumer banking. Net revenue increased by 5%, with a 6% increase in net interest income, driven by a similar increase in loans. The loan growth was aided by good growth in the cards portfolio, which benefited from the new Costco branded products. This offset a 2% decline in non-interest revenue. Credit costs were up by 24% due to weaker collections activity, particularly in North America. The efficiency ratio remained stable at 56%, as expense growth was in line with revenue. The increase in credit costs and weaker non-interest revenue resulted in a 12% decline in earnings. In North America, net income was down by 18%. This was largely due to the weaker mortgage banking performance in a very competitive market. This was not unique to Citi, and we have seen this across the industry. Slower collections and therefore higher credit costs also contributed to the decline in earnings. Net income from the international business fell by 3% or 2% when eliminating the effects of exchange rate movements. Now onto the capital position. I'm going to start off by explaining CCAR for those who are not familiar with it. CCAR, or the Comprehensive Capital Analysis and Review, is an annual process undertaken by the US Federal Reserve to test the strength of financial institutions. This occurred in June of this year. The process includes stress tests on the bank's capital positions. I'm not going to get into detail of the assumptions in the stress test, but I just want to highlight that the assumed conditions are quite severe. CCAR also provides the opportunity for banks to request for higher capital returns to be approved by the Fed. When I reference capital returns, I'm referring to both dividends and share repurchases. Citibank's Common Equity Tier 1 or CET1 capital ratio of 13% is well ahead of management's target of 11.5%. The group will achieve this reduction through capital returns. In the 2017 CCAR cycle, the Fed approved capital returns of around $19 billion, including gross share repurchases of up to $15.6 billion over the next 4 quarters, and a doubling of the quarterly dividend to 32 US cents. These capital returns are around 140% of consensus expectations for earnings over the next 12 months. This is shown in the chart below. The gold bar shows the capital returns, and the grey bar shows consensus earnings expectations. Therefore, we should see the group's capital position move to within the guidance, with a return of capital to shareholders greater than capital generation, which is essentially our earnings. As I alluded to earlier, lower capital levels will drive a higher return on equity. Lastly is the company guidance. Management's focus is to increase both the returns of capital and returns on capital. The medium-term guidance includes net revenue growth of around 3%, net income growth between 5 and 10%, and EPS growth between 15 and 20%. The faster growth in EPS relative to net income shows the impact in the decline in the number of shares through share repurchases. By 2020, management aims to achieve an efficiency ratio in the low 50s and a return on tangible common equity of around 11%. And that concludes my presentation. Thank you for listening and enjoy the rest of your day.